All right, everybody. We are welcoming back Katara from TappAlpha. We are going to be talking about some updates around TSPY, some news, some lessons learned, some updates. An interview like this probably would have happened like a month ago. We were chatting and crisscrossing emails back then, but just due to some scheduling issues, we've had to wait for it. But it's probably not a bad time to wait because there have been some things that I've noticed with TappAlpha, even as recently as like the morning of recording I'm going to touch on, and of course just the obvious growth of TSPY. So welcome back, Sai.
Jordan, great to be with you. Thanks so much for having me. And yeah, it's good to stay in contact. You and I first talked, I think, way earlier in T-Spy's journey, and so there's just been a lot of change, growth, but also like I think more importantly, learnings as you kind of go through the process and you stub your toe a few times or you learn about different pieces. And I think that's what helps us grow the most. So I appreciate you having me on to have the conversation.
No problem. So when it comes to, I gotta start with this though, because this is the exciting part, and T Spy is kind of like to me personally, it's sort of like it's almost like my spirit animal or spirit fund in a way, just because you latch into a couple of things that I really like, which is income and growth. And as I tell my audience on such a consistent basis, my whole goal is really to find that sweet spot between what is the maximum yield with the maximum potential return that you can get almost in equilibrium with these two things when it comes to investing for income. It's not just all about just the highest yield you can possibly get, because I still want my underlying principle to grow over the long term.
Yes.
I'm 35 years old, so I still got more years ahead of me than behind me. Yeah, let's. I wanted to just mention the fact that I think as of yesterday, so this would have been Thursday, March 12th. I saw on X, so I follow you guys on X. You guys posted just a thing celebrating the milestone of $25 million in AUM, which is
Yes, sir.
awesome. That's great. And through my tracker, I record AUM month over month. I want to say at the beginning of March or just before, when I record AUMs for all the fund managers, you guys were maybe somewhere, I want to say like $18 million, but we'll just say maybe between 18 and 20. And then, so capsulate that. So I see this post this morning, but I will go onto your website this morning. You guys are like at $29 million in one day. So this thing is just picking up like crazy. Maybe you can speak to that a little bit.
Yeah, I think a big part of it is exactly like you said, people that want the balance kind of opportunity. And then we've actually part of the fun part has been, the early conversations with retail investors. It means so much to us that you believe in us to trust us with your assets. And like the retail folks got us through these really big gates. Once you cross 10 and then 20 million, all of a sudden it opens doors with advisors to now have conversations where advisors are now gravitating towards it and placing it in their portfolios as a core equity sort of solution for their clients. But we couldn't get there without the support of the retail groups that are always going to be the earlier adopters of new ideas and new funds. So, it's kind of like this unlock that happens at these levels, 10 million, 20, 25, the next level will be 50 and then 100. All those kind of moments open new opportunities with new audiences that are open to sort of exploring the fund. So that's where you're starting to see that exponential growth start to happen, is when we reach those levels. And we couldn't do it without the audience that supports the fund. So we really appreciate it.
Absolutely, and I think there's probably, I would say, two kinds of income investors. And it really is, you got the crowd that really wants to focus on getting their return through the yield, but that will require more reinvesting naturally, versus maybe the people that want to be a little bit more hands-off, passive, and probably still want to be able to see some green in their portfolio. It's almost like a psychological trigger, right? The fact that I think you'll sleep easier at night if you know that, hey, over the long run, I could still see some growth, I can still see some green in my portfolio over time, and I can enjoy some of the return that this fund offers through the yield, whether it be in that sort of 10 to 14% range, but still be comfortable that I'm going to get growth over time. Maybe it doesn't. It doesn't exactly, just on a price level. Maybe it doesn't match, say, the S&P 500, but nonetheless, it's still growing, and maybe you're still confident it'll grow over time.
I think that's right, and and it's another good education point too. When I was learning how to communicate about the fund, there's two performance metrics that you can look at. One is the one you just mentioned, which is price performance. But of course, your income investor audience knows like price actually removes all the distributions from it, so you're actually lower than the second metric. That's actually a really good apples to apples comparison, which is total returns. So
Yes.
if you look at total returns for your income funds versus the S&P, that's a great apples to apples to say how is the macro performance doing. And then distributions come out of that. So that is more sort of the short term, hey, what can I pull out of the fund in a tax efficient way, which is really important too. But those two metrics are really important for income investors to understand what the difference is. And I even get that question from seasoned advisors too. They're like, oh, well, I pulled you up on Yahoo Finance, and why is your market price less than the S&P? And you have to sort of educate folks that have been in the industry for a long time. Yeah, you got to add back in the dividends in order to get the apples to apples comparison.
Very interesting to hear that from, like you said, like, say, seasoned professionals in the industry, right? So yeah, very interesting to hear that. So is there any other kinds of updates, news, lessons learned that you can kind of touch on with TSPY? And obviously, being an engineer, people can maybe coming into this for the first time don't realize that you don't actually have a background in finance, but you're actually an engineer. And how has that experience, how has that been able to translate into the finance space?
It's been a blessing, to be honest. And the reason is coming into finance with an engineering mindset, I've got like really fresh eyes. And I'm seeing things and asking questions that people that have been steeped in the industry for 20 years it doesn't occur to them to ask. And so there's lots of drivers behind why people do the things they do in the industry. One of them is compliance, right? You have to be compliant because this is like transparency, it's publicly traded. You have to do it within the bounds of the compliance framework. But people don't actually like go and read the CFRs to understand what that is. So when they're like, oh, well, you have to, it's always kind of done this way. I'm like, okay, let me check. And I go and review it. I'm like, why is it done this way? And then I learned so much through that process to say, well, we can actually do it a different way. Is there any reason from a compliance perspective that we can't? And then I send them the CFRs and they're like, well, I guess you're right. We can do it this way. So that's one of the things that I've learned is like stay curious and keep an open mind. And when somebody tells you, well, we've always done it this way, that's a red flag to say, okay, let's take a peek and see if there's actually a better way to do it. So the engineering brain in the finance world is a really effective thing just because you come with fresh eyes and a really procedural and analytical approach to try and solve problems in order to deliver value for your investors.
Yeah, I would say in my experience covering these funds, there's obviously some very big fund managers out there. I can think of a couple in Canada that first came, right, they came out with CoveredCall ETFs maybe 10 to 13 years ago, and maybe at the time they were innovative maybe, but still kind of clunky at the time. But as an income investor, even back then, you wouldn't have really known any better. You wouldn't have known maybe it could be better until maybe more recently in the last few years has this industry really exploded to show how much better it can get with some of the competition. But anyway, some of those bigger fund managers, they are big, still have big AUMs, but they're not innovating. And maybe people just kind of feel safe with those big entities just because there's that psychological effect that, oh, it has a big AUM, so it must be okay. Even though there are certainly other better strategies out there, maybe have smaller AUMs, maybe newer fund managers. And like say in TappAlpha's case, maybe a good analogy for you guys, maybe not so much anymore, but I was thinking about this, how it's almost like TappAlpha is kind of like that student coming out of university, right? It's like you need, like the student coming out of university is now looking for the job to get experience, but the people hiring want experience to get the job,
Experience,
right?
chicken
It's
or
sort
egg.
of so it's this it's this dichotomy of like of just showing people like, hey, like look at my credentials, look what I can offer, and give this a test run. And why I say I don't necessarily think as much of that anymore is because we are seeing such an, like you said at the top of the video, now we are seeing much more traction behind TSPY, and its AUM now is growing further and further. And I mean, when does it get to a point when you say, okay, we're going to start exploring other funds or maybe other offerings that investors have been wanting or calling you guys about?
Yeah, I think, part of it, T-SPY is to prove the case, and it's to prove the case on two levels. Level one is there market demand? Is this solving a problem for people? And then the second is, do we have the tools to go and access that demand and deliver value to that demand? And so as we're growing AUM, having more conversations about it and getting feedback on it, we're trying to prove out those two cases. And then this case can scale to many, many other underlying securities and potentially other strategies. But like the thing that I learned being an entrepreneur for so many years is like I get excited about new opportunities and I see them everywhere. And early in my career, we started to chase so many beautiful butterflies, but you totally diffuse the limited resources and time you have if you don't stay focused. And so I'm forcing myself to stay laser focused to make sure T-SPY is nailing it for investors from a performance standpoint and just from a transparency standpoint so people know what's going on. And then once we click to a certain level, then we can start to scale to new funds as well. And so I want to put a pin in that for a minute because I do want to make an announcement of what the next strategy will be. But back to the discussion about what have we learned? And do you go with the bigger fund managers or the smaller? Two things I'll say. Number one, like the smaller fund managers have a lot to prove, and we're going to fight and we're going to work. And also, like in our case, like our resources are invested right alongside yours. So we have, accountability from that perspective. And that's also why it's so important to get feedback and support for this. So that's why like the early adopters of T-SPY will always have a special place in my heart because it's the most critical period from 0 to 25, 0 to 50 to get a new idea off the ground. And we couldn't do it without the support of people that are early investors. And I'm so glad to hear the feedback that it is, hopefully checking the box for all the expectations that were set for what T-SPY can deliver. The second thing, and this actually has multiple legs on it, how we implemented T-SPY was a fight. We were, to your point, like working with these big custodians at big banks, and because we're doing the zero-day strategy, it was just so frequent. And they're like, we can't operate a fund like this. Why don't you change your implementation idea and instead just do it implement it as a swap? Or why don't you just do it as a synthetic so you don't actually have to collateralize an option position with real shares because that's hard for custodians. And when we did it, we were like, no, we have to own the real shares because number one, like, how am I going to tell, my mom who owns SPY, like, oh, get rid of that SPY, put T-SPY in, and she'd be like, well, do I still own shares of SPY? And I'd be like, no, you just own a synthetic option that does things similar to SPY. Like that just doesn't feel secure to people that are thinking of it that way. And then the second thing, so we fought, and that's what took us an extra few months to get it to market. But when we did, we learned that there are massive reasons that this is a benefit. So the two biggest ones, number one, end of year just happened. If we had to go and implement T-SPY as a synthetic, what would have been really difficult to swallow because we're growth plus income is at the end of a fiscal year for a fund, if you have, options contracts to simulate the underlying and options contracts for the covered call, whether you close those out or not at the end of the year, you have to do this thing called mark to market. So that means whatever gains were realized in the synthetic, you actually have to um, effectively simulate that you sold those for a gain potentially. And in an ETF, when you have a gain, you have to distribute 90% of that gain. So if you're looking to store capital growth over the long term, like just buy and hold for SPY, you can't accomplish that with a synthetic. So if I like yielded to the banks and said, I'll just do it synthetic because it's easier for you to implement, we would have lost a huge component for the growth side of the growth plus income story. So that was a big win. And then the second thing was the tax implications. Because if you can keep the value, the growth side of the equation in the SPY shares and it grows over time, you can hold it for the long term and not have to deal with every end of year realizing and taking distributions that you may not want to take. So from a after tax value perspective, it is a game changer potentially. Now talk to your tax accountants and verify this stuff, but when you don't realize a gain, there's no tax to pay. And when you can keep it within real shares, that's a good way to keep it as a value store. So those two things were huge benefits for us for what we were trying to accomplish with the fund, versus if I just kind of was scared and said, well, okay, I know I'm new here, so I'll just trust you to steer me in the right direction because that's what I'm paying you for as our, custodian or whatever. We wouldn't be in the position we're in. So really good learnings, and I'm so happy that we stuck to our guns because it's had huge benefits for our investors.
I also think that, like, again, talking about the psychology of an individual retail investor, when they check out maybe TappAlpha or any maybe say smaller entity, uh, you guys actually partner up with some big institutions. Like, your team is actually more broad based than I think maybe people realize. Is there anything that maybe you can speak to of like how many entities that you actually work with?
Yeah, it's so especially in an ETF, which is a 40 Act product, which is highly regulated. So we have a big bank, US Bank is our custodian. So the assets that are invested in TSPY live there. We have an executing broker, which is GTS, who actually gets really good executions for the options positions that we trade every day. We have a clearing broker because you have to like clear the execution that was done. That's ClearStreet, and they help collateralize everything. So we have a nice workflow between the bank and our clearing broker. We have a trading sub-advisor, Pedal Capital Management, who has anywhere between 3 and 5 billion under management. So these are all big dogs that have been in the business for a long time that know their world really well. And then we can complement that. And then we have, of course, accountants that do the audit, the tax side of it, the collateral side, and then also the accounting side. And so there's all these. There's probably 30 humans that kind of touch the fund to make it work, which actually yielded another challenge. So we have a lot of really big, well-established, reputable, amazing partners that we work with, which is like the most important thing. Is you're a new provider, partner well, because that'll change the game for how you can actually execute your strategy. But the opportunity that made was I came in from the tech world, and everything in this industry was done with email and spreadsheets. So I'm like, wait a minute. I'm going to trade maybe 1 to 3 trades a day, depending on what happens. And every one of those, you have to send an email and a spreadsheet to all these entities that need to know it right now to clear it. So one of the early things that we did was we actually developed software that took for one trade when we started, it took maybe 2.5 to 3 hours to get it into everybody's hands and get all the things done and to collateralize it through the OCC. We wrote some tech, and now it takes 3 minutes to do it, tip to tail. So just that, there's so much opportunity to come in with a new lens to try and do things differently because there's always a better way. Technology is great as a function of how do you get more humans connected to the central information you need to execute these things, and that's like opportunity one that we already kind of tried to tackle. So there's just, and you can probably hear my voice, but like those problems are opportunities, and it's so much fun to come in and be able to like see these things and take action to address them in order to like drive an outcome, like running a publicly traded fund that's performing exactly how it's designed. So it's just this. I'm just having the time of my life in this new industry, and I think this. I found my new home.
For sure. And I think there's one thing that I'll speak for the audience on this front, and maybe even more so for myself. I really appreciate it when fund managers try to make their funds just better instead of taking a shrapnel strategy to their lineup, just new stuff every which way. It's like, how can we actually make our funds a little bit better? And there's a few in Canada that have done that. Obviously, I'm Canadian, so focusing on the CoveredCall ETF landscape in Canada, there's been a few funds over the last couple of years that have, even older funds that were dinosaur funds, and then they spun them around in a slightly different way, still kept some of the underlying, but just switched up things a little bit to make it more appealing and to also kind of get with the times. So it seems like, Sai, you're at the forefront of that and trying to make that happen within your own product. I do have some subscriber questions that we could get
Sure.
to. And
Great.
so the first one is, what is the difference between AUM and NAV, and how are fees collected?
Got it. Great question. So, difference between AUM and NAV. So, AUM are the assets in the fund, and then NAV ultimately has a few factors to it. So, NAV takes the AUM that are delivered to the fund, and it breaks it into the components called a basket. And so, the NAV is essentially the sum of all of the assets in the fund divided by the number of outstanding shares, and that's how you get to your NAV number. One thing that a lot of folks get kind of confused by, so NAV and ETFs are really interesting because they're open-ended, right? So NAV is really just a function of what assets you really have, but it's still traded on the market. So then there's a market price, and sometimes the market price and NAV don't match exactly one-to-one, and there's either a premium or a discount. That's just the function of being traded on the market with some supply and demand difference. But really, the fund's value is the components that make up the assets on the fund's balance sheet. And so that's how those things kind of work together. And then when people buy shares of TSPY, you buy 10 shares. Like, we don't see anything on our side until there's like a big kind of either backlog or more inventory is needed. And then the banks and the market makers and it's called an AP, authorized participant, they're like, oh, there's more demand, so we need to create more shares of TSPY. And they do that in bulk. So like in 10,000 share blocks called create blocks. And that's when they basically create more shares. They buy all the components that make up TSPY, and then they give those shares out to the people who bought it, and then they put the assets in the bank with all the components cash plus SPY shares that make up the constituency of the fund. So it's a pretty interesting process. It's really neat from a market dynamics perspective because even from advisors, I get the question, okay, so if I make a big placement, like what's your liquidity, and like is it going to spike the price of TSPY? And I'm like, no. And the reason is the liquidity is not based on the volume of TSPY. The liquidity is based on the volume of the constituents that make up TSPY. And guess what? We're trading SPY, the most liquid ETF on the planet, and we're trading SPX, the most highly traded options on the planet. So there's no liquidity challenge there, but even advisors don't necessarily understand that. Yeah. So the second part of the question. So the way that it works is the custodian extracts, so they do a snapshot of what's the AUM on a given day. And then they equitably extract the equivalent of 1 day of 68 bips. So if you take 68 bips and divide it by 365 days, they take that sliver and they retain it within the bank, and then the bank pays the fund trust, basically the fund administrator, that little amount. And they do it on a monthly basis. So they'll kind of add it up over the month, they put it on their balance sheet, and then they send the funds directly to the fund administrator. So for us, like until we get break even, we don't see any dollars directly to us until we actually like cover all the fund fees, which we are kind of getting close now. So essentially the fund administrator gets paid, and then when we start to grow AUM, then they'll on a monthly basis provide that sliver of fees to us downstream.
Okay. Yeah, that's something I didn't realize, is the fact that you might not necessarily, so if I get this right, you might not necessarily see like a portion of that management fee until you get to a certain AUM.
Yeah, we don't. And then from the investor standpoint, the returns that you see like charted, those are net returns. So those are they take all the fees and costs out, and commissions and all that stuff for the trades, and then they show you what the returns are. So what you see is like the after fee returns of the fund, so you don't have to like think about extracting any more from what
Yeah.
you see in the market performance.
I see. Right on. I think that was a great summary of just how fees work, because I know people are going to have that's one component of their investments that might be a bit foggy, and I know that's
So
certainly a
foggy.
question that comes up every now and then.
It's so foggy because, like, in any context, you just see these investments and then you see a number, but there's no like really transparent way to just be like, oh, over this last year for my investments, the fee for the fund was this many absolute dollars. Like, there's no reporting for that, and there should be. But ultimately, it's you see it in the returns. Your returns, if you have a high fee fund, your returns are going to be lower because you're paying that gain in fees somewhere else. What I'd love to see is like a simulator that's like, okay, I'm paying 1% in fees for this. So over the next 10 years, what is my absolute dollar of fees if I invest $25,000 in this
Uh,
fund? Like, that would be so helpful, but it's not available, which is one of my frustrations in the industry of like, why can't we just be like really, really transparent with exactly what those components look up to, right?
yeah, I see. And then this is always one topic that comes up a lot is when it comes to the tax classification, say of TSPY, how does return of capital play into this? Now, again, this is always can be a polarizing topic for income investors because on one hand, you're going to have a group that are going to say it's going to grind the NAV down. You're going to have another group that's going to say, well, it's actually a tax function entirely. Can you speak to maybe those two worlds? Is it maybe a push and a pull in both of these directions?
It's such an important question, so much so that we wrote a blog about it. And I'll send it to you if you want to post it with the video. It kind of breaks down the why, especially for ETFs, use return of capital. So I'll start with tax classification. So we were really pumped at the end of 2024 when we got our tax classification back. So there were two categories. For the three distributions we did in 2024, 17% of those distributions were qualified dividends because we distribute out all of the SPY dividends that come to the fund, we distribute straight to investors. And then the remaining 83%, we deliberately got qualified as return of capital. And the reason we did it was because of the tax efficiency, where we don't want to realize the gain in the short term because obviously that's a tax potential hit. So we want to defer that over time so that you can actually get it qualified as long-term capital gains when you sell TSPY down the road. So to your question, why? Couple things. Number one, like when we're distributing, this is one learning. Income investors really, despite the craziness of the market, kind of count on income funds to be steady Eddie. Like, can you just give me consistent income every month? If you're going to do that and the markets are doing this, the funds have got to come from different places. So one of the things that you can do, like let's say it's an underperforming month where you're not getting all of your distributions from your options premium. Maybe there's some capital growth that you can use to cover some of that distribution. Well, then you have a choice. You own shares of SPY at very many different purchase points. So you can choose, do I want to realize gains? Or what we do is we actually match selling price for SPY if we have to sell a few shares to get that consistent income with the price that we bought it at, so we have a neutral. And by doing that, we can distribute that gain tax efficiently as return of capital. And the reason for that is because we are trying to sort of do the deferred long-term, the tax efficient way to deliver consistent income without incurring big tax events in this calendar year. So we're going to continue to manage the fund that way so that when we distribute, it's as tax efficient as possible. The second thing that is really interesting, this is another learning that I had coming into the industry. ETFs are part of the 40 Act in the US. So in 1940, they created this thing so you can create these investment companies and do funds like this publicly traded. But there are some archaic rules. One of them is, and they did it for a good intention reason. They said you cannot distribute capital gains more than twice per year, maybe 3 times if you apply for it. So as an ETF, when you're distributing things over time, you don't actually know what your capital gain is going to be at the end of the year when you're 3 months in, because markets go up, markets go down, you don't have a crystal ball. So the safest way that ETFs kind of are able to distribute is they in the short term, they give an estimate of return of capital in those 19A1s. And the reason they do that is because if they categorize distribution on a monthly basis as long-term or capital gain, then you just check the box for one of your 2 shots to distribute capital gains. You don't actually know that answer until the end of the year. So it kind of buys you time to do the distributions, and then you do your best to estimate what your actual capital gain distribution is, but it's really hard month over month when you're trying to distribute in a consistent way. So the article kind of speaks to it a little bit more, but anyway, probably too much to wrap your head around from an investor perspective, but it's important to know the why, especially income funds do what they do, and that's the main reason we do what we do.
I see. Is there any tax loss harvesting in that as well for?
There potentially is. We are doing it neutrally with the underlying, just because we don't want to poke the bear on like over harvesting tax loss to offset the option premiums, because that it becomes a whole straddle issue. So we're just like categorizing option premiums in one bucket and then underlying in another bucket and trying to be as tax neutral as possible.
I see. Okay. Yeah, thank you for that. I got another subscriber question here for you. I think this one should be a layup for you, really. If the underlying asset gets called away on, say, day 1, do you buy them back 100% on, say, day 2 and write 100%, if that makes sense?
Great. Yeah, makes sense. Great question. What's awesome about trading SPX options, the index options, is they're cash settled. So there's no call away risk. Basically, if you get called away, they call it an assignment. You just have to pay the cash difference in order to cover that delta of what what that difference was. So the shares never get sold as part of an options transaction, which is so nice. When I was doing this before my individual income account or my individual investment account, I would get called away, and guess what? When you get called away, it's a tax event, and I'm like, oh, I just realized all this gain, and I'm just going to buy it back tomorrow morning anyway.
Yeah.
We don't have to deal with that now, which is such a lifesaver in being able to trade these SPX options. But yeah, so we end up basically still writing up to 100% of the next day's balance of shares that we have in the fund.
I've noticed with many American fund managers, this is one big difference between Canada and the US, and just how fund managers write, or how they write call options on the various coverage. I notice a lot of American fund managers do 100%, right? They write everything that they got, and maybe you gain a little bit of growth, depending on how far out of the money you are. On the Canadian side of things, this is actually more rare, actually. They might write calls on average, maybe between 30 and 50% of the portfolio, allowing the other 50% to be unbound, do as the market will do. Is there any particular reason why most fund managers in the US do not take like a half and half approach, where they say write 100% on the first 50% and then just leave the other 50% just to do whatever the market's going to do?
I think there's a couple reasons for it. One is it depends on where you're writing the calls. So there's 2 variables, right? What percent do you cover, and then how close to the money. In my engineering brain, it's easier to isolate variables, so we have one variable. It's how close or far from the money. And that's really where like all of the technology is focused on optimizing. Versus if we did the other run where let's say you did 50% of the coverage, but then you wrote it way closer to the money in order to make up those premiums. It's different math, different calculus, different considerations to figure that out. So that's one thing. Two, it's also sometimes harder to communicate the two variable thing. So you said it really well, but a lot of people and advisors and investors, they're like, wait, so what's better? Is it 50% at more risk or 100% at less risk? It's easier to explain 100% at less risk. That's how we manage it. But there are some American funds that do a lower percentage, but then write it a lot closer to the money. We've just optimized it this way. That's one thing maybe for us to do research on is like, oh, if we did 50% and then a different delta variant, then maybe we could end up more optimized. But so far, so good, where we're still outperforming the underlying index, and that's kind of the goal. And the other thing I've learned in this process is just don't get greedy. Like, do the thing that's going to help you hit your goal of what you're trying to collect in premiums. Just don't get greedy, because the markets, as you can see over the last month, are doing crazy things, and that little bit you can get extra sometimes just isn't worth the extra risk that you take.
That's all great information, Cy. And I also really appreciate the part where you talk about real shares versus the synthetic shares. I like to call them mechanized fund, or like they're mechanism funds, because like you said, they don't invest in any kind of underlying. I'm very much a person that appreciates having the underlying shares with all my investments. So that's like a guardrail I've put up for myself, is that always just stick with stuff that is effectively tangible, that you can, it's kind of like Warren Buffett says, it's like the farm, it produces something other than something that's kind of abstract. That can also, not to say that fund managers are untrustworthy, but I just think if a fund is more complex and if it's harder for investors to grasp, it can maybe potentially leave some room for the fund managers to, do some sneaky stuff. But again, no, that's not something I have personally seen, but that's just where my head goes when something is just a little bit more complex, that they can maybe kind of hide some stuff, but who knows?
Yeah, that's why simplicity is nice too. There's no like magic cup game where you're trying to figure out where that moving dollar is. Like if it's simple and clear and transparent, you can get your head around it, then it's something that people can potentially use. But if it's too complicated for people to understand it and there's places where it's squishy, then it's a little less comfortable to put your hard-earned assets in something like that. So that's also why we were like, okay, in doing the funds that we want, like let's keep it crystal simple. It's just SPY, daily covered calls. That's it. And hopefully it's pretty straightforward to people to understand, and then the benefits behind it. And then the coolest part about ETFs is they're all open and transparent. So you can just watch it go. You don't have to justify, oh, the performance was X in our model portfolio. No, this is the real stuff. And it's all out there for the world to see. And that's my favorite part about proving the concept in this way.
Absolutely. Like I said, really like that too. I think we're both on board with that. So I guess last question before we end the interview, Sai, is just maybe in the next couple months, can we potentially expect TDAC to hit the market?
Great question. So we did just recently announce, as soon as TSPY hits 50 million in AUM, and we're at 30 now and growing, as soon as we hit 50, TDAC is coming to the market too. So that is basically the same strategy, but instead of the S&P 500, it's going to use the NASDAQ 100 and writing daily covered calls on that. So if that's your security that you love, there's more volatility there, so a little more option premium to harvest. That's going to be officially our second fund as soon as Fund 1 gets to 50 million.
Nice. Well, I appreciate this side. Thanks for coming back on once again. No doubt, I'm sure we'll do this on a regular basis, and just to get your thoughts on just the industry as a whole.
Excellent, Jordan. Thank you so much for having me. I always have a good time and can't wait to come back.